So let's begin. So I'm gonna start from the very beginning. I'm just gonna assume that none of you have any experience in trading, so that the people, even the ones who are experienced, I'll just I'll just say it from the beginning, so that the ones who are not very experienced, they can catch up. So what is trading? So trading has definitions for different places, but in this context, in the context of cryptocurrency trading and all that, trading is buying and selling assets. So buying and selling Bitcoin or Ethereum and all that. So it's either buying and selling with payment, so you can directly buy, or you can exchange different currencies for one another. So you can exchange Bitcoin for Ethereum or vice versa. So in this context, trading usually refers to short-term trading. So when you're buying and selling in the short term, that usually refers to trading. So these are very important terms that are used in this context. You must have heard of most of these, so I'll just go through some of them. So exchanges. So this is what we run. We run an exchange called TriUnits. So this is a facility where you can go and buy and sell those cryptocurrencies or different assets. And the next two are bear and bull. So bull just means you're optimistic, and bear means you're pessimistic. So a bull market means you think that the market will go up in an upward trend, and bear market means you expect the market is going in a downward trend. So bullish and bearish, same thing. Like you're optimistic. If someone says I'm bullish on Bitcoin, that means he expects the Bitcoin price to go up in the future. Order. So order in most contexts, like for example, if you do online order, you're just buying something. But in this context, you can either you can have a sell order as well. So you have an order to sell your asset. When I say asset, I just mean Bitcoin or whatever things you want to sell, financial assets. Another two common terms are long and short. So long means to bet on the price going up, and short means to bet on the price going down. So long is very simple. Long is you buy Bitcoin in the hopes of selling it in the future for a profit. And short is a bit different. So you sell it right in the present time and hope to buy back at a lower cost. Or you can even borrow assets and sell it and buy it back in a lower cost. So hodl, this term is very exclusive to the crypto field. So this is commonly used in cryptocurrency areas only, not in other financial markets. So hodl just means hold on for dear life. So people say like just hodl. So whatever happens to the market, even if the value of Bitcoin is going up or down, or other currencies are going up and down, you just hold on to it and you don't sell. Exposure just means the amount of money that you're invested in the market. So if you have 10,000 rupees invested in Bitcoin, you bought 10,000 rupees worth of Bitcoin, that means your exposure is 10,000 rupees. So what is investing? So investing and trading is different. So investing is when you buy something, accumulate something in the hope of getting a high return in the future. So investing in the future. So investing compared to trading, investing is more long-term approach. So you're planning to get the profits in a later date, not in the present. And investing, you're mostly focused on the fundamentals, so the workings of the asset or the currency. And short-term price fluctuations in the market, they don't really affect you. So these terms I'm just going to run through these. These are not very important. I'm going to go more into the trading later on. So these terms are raised, these concepts are raised in the graph, so I'm just going through this quickly. So investing means just large returns in the future, and trading means small returns frequently in the present. So why cryptocurrency trading? So there's many other tradings. You can do stock trading, forex, and all that. Why choose cryptocurrency above all those? And simple answer is it's very low barrier of entry. So you must have heard like many students in India started trading cryptocurrency these days because it's much more easier to get into, and it's a low barrier. It's much easier to make an account and start trading cryptocurrencies than it is to do with like stocks and all that. And the fees are much lower. So for example, for a student, it's much better for them to invest in cryptocurrencies. And also, unlike stocks, the stock market in India is open from 9:30 to I think 3:30 p.m. But cryptocurrency exchanges are open 24/7, so you can trade anytime. And this is particularly helpful for students because most students, instead of uh, waking up early and all that, they usually stay up late, and so you can do trading during that time. And during the daytime, students have classes, so it's not very convenient for them to trade in stocks and all those. So trading in cryptocurrencies is much more convenient for students. And when you're trading, you have to be wary that you have to be very wary to pick the right currencies and to pick the right things to trade in, to buy. So because all cryptocurrencies are not made equal. So I'll just tell you all the different types of things, currencies that you can trade in. The first one is currency tokens. So tokens it just means something that's built on a blockchain. So I'll just remember that is the most simple definition of a token is that. So currency tokens are things like Bitcoin and Litecoin, where it is built to be a currency. So it was built to be a currency. So they don't have any other functions other than to be a currency. And these are other types of currencies as well. I mean, tokens. So exchange tokens, for example, like Binance Coin. So these are tokens that are built by exchanges. And the benefits of these tokens are they might have lower fees in their specific exchanges and all that. Utility tokens. These tokens are tokens that grant you access to the blockchain and you have some utility with them. Stock tokens, these are actually very different. These tokens, their value is based on a stock, so the price goes up according to stock. So there are certain benefits and pros and cons to buying tokens instead of directly buying the stock. So I'm not going to go deep into that because these things you can do research by yourselves. And I will request all of you to do proper research in all of these. Like if you're planning to buy, instead of blindly just following trends and hype, I would request all of you to just delve deep into all these tokens and read about them. The other token is NFTs, like I said yesterday. NFTs are non-fungible tokens. And of course, there are lots of CAN tokens as well. You must have heard of this what's the Squid Games token, Squid Game coin. So this people who don't do their research properly and just blindly follow this hype and all, it's very risky for them. They have a big chance of losing their money. But as long as you do your due diligence and as long as you do proper research, you shouldn't be scared of these scams. So tokenomics. Tokenomics, what it means is that tokenomics comes from the two words token, like I said, explained before, and economics. So just supply, demand, and all those economics. So what it means is you do research on the economics of a token. So for example, you can check out the value of the currency, you can check the supply of the currency. So for example, Bitcoin has a fixed supply. So what is the current supply and what's the maximum supply? Volume, the amount of currency that's being traded. Market capitalization or market cap, and the size of the market, how much money is invested in it. Crypto holders, who holds the cryptocurrency or tokens, who are the holders, burning tokens. So some companies or some founders, they burn tokens, and when the supply drops, and the demand is still high, then the price can increase. And ICOs are just initial coin offerings where companies release these tokens so that it helps them fund their project. So you have to research all these things when you're going to invest in a certain cryptocurrency and do your due diligence. I'm going to go more into tokenomics now. So these are, for example, this from CoinGecko. This is the tokenomics of Bitcoin. So this is the price of Bitcoin. This was taken yesterday. And this is just a 24-hour change from yesterday, how much the cryptocurrency value changed. This is against the US dollar. So not against rupees or anything, this is against US dollar. And this is the volume, the amount of money that has been traded in Bitcoin in the last 24 hours. And this is the market cap. So I'll show you how to calculate market cap. So if you go more into detail in CoinGecko, if you click on Bitcoin, you'll open this page. So in this page, you can see the current price here, and you can see the market cap here. And down here, you can see fully diluted valuation. Fully diluted valuation means It's just the price into the and the complete supply, the max supply of the currency. So circulating supply is the current amount of Bitcoin that's in the market. So Bitcoin, there's a fixed amount, right? There's only 21 million amount number of Bitcoins in the market ever going to be created, and it's being released slowly over time. And right now, currently, it's only 18,975,000 are in circulation, and this is the max circulation. So to calculate the market cap, you can take the current circulation of Bitcoin and you can multiply it by the current value and you'll get the market cap. The next thing to look into when studying tokenomics is the project docs. So you can study the project docs and see the allocation of the currency, the tokens and the currencies. So you can see how much the public holds and how much the founders and the insiders hold. And so if you go into more detail, for this is Solana's token distribution. The early investors, they hold 16.23%. And the team members, they hold 12.7%, and the foundation, they hold 10%. And the amount that is released to the community that people are trading is only 38.89%. So why is this important? This is important because, like that Squid Games token, the creator of the token was holding a lot of the token, a lot of the percentage by himself, and in doing so, there was a huge risk of him dumping everything, and he did dump everything, and the value crashed. So when researching Bitcoins and other currencies, you have to delve deep into those, and I would recommend reading the white paper. So white paper is just information about the entire information about the currency or the token. So you just read the white paper, and you can start by reading of Bitcoin's white paper. Bitcoin's white paper is actually very short. I think it's like 8 pages or something. So you can start off by reading that and get a better understanding of everything. And it's actually written very well and it's easy to understand. So to start trading, the first thing you have to know is stable coins. So what are these stable coins? These are tokens or cryptocurrencies that are pegged to a real world asset. So it can be pegged to gold, or in the case of Tether, it's backed by US dollar. So what's the use of these coins? I'll tell you later on, but some examples of stable coins are USD Tether. So this is US dollar Tether and US dollar coin. So these stable coins are important because, for example, if you think that the value of Bitcoin is going to go down, but you don't want to convert your Bitcoin into fiat currency because of the fees, because usually they have higher fees to do that. So what you can do is, instead of converting your Bitcoin into fiat currency, you can convert it, you can trade it to a stable coin like USD Tether and keep your money in that. So compared to Bitcoin, usually these stable coins are very stable and not volatile. That's why they're called stable coins. So you can store your value there. And when you think the market is going to recover, you can go back and buy this Bitcoin again and with lower fees. So exchanging with cryptocurrency usually have lower fees than going from cryptocurrency to fiat currency. And also stable coins are used in trading pairs. So what are these trading pairs? I'll tell you. So in exchanges, you can trade cryptocurrencies through only pairs. So you can trade with one another. So one currency with another currency you can trade, and each currency will have you'll be listed as a pair. So let me show you what pairs are. So this is our company's website. So if you go here, you'll see all these pairs, right? You see here ETH BTC, so this Ethereum BTC Bitcoin pair and all these things. So pairs are important because it is used. I'll go more into the importance later, but these are some examples of pairs. You can have Bitcoin and USD Tether pair. You can have Ethereum Tether pair or BTC Ethereum pair. So you can buy Bitcoin with Tether, you can buy Ethereum with Tether, you can buy Bitcoin with Tether, and all these different pairs. So why are pairs important? So, oh no, this is, I'll explain more about the pairs here. So these are how the pairs are shown in exchanges. So I'll just show you. This is USD, Bitcoin and USD Tether pair. So you can see the pair is listed here, and this is the price, and this is the change in value. So I'm just gonna show it here in the slide because here it's moving around, so it's harder for me to show you. So this is called the one on the left is called the base, and the one on the right is called the code. So you use the code here. In this case, is the tether. You use this to buy the base. So, and this is the amount of code you need to buy the base, and this is the change in the value. So this is the amount of code needed to buy the base has decreased by 3.27% since yesterday. So this is how to read this simple thing. And so not all pairs are available. So for example, lower market cap coins like Mana and Cardano, for example, they don't have a pair. So why not? Because if you have pairs for every different currencies, then the market gets diluted. The trading will get diluted. Like there'll be too many different pairs, and not enough people buying or selling in them. So it'll get diluted and be more difficult to trade. So if what happens if you want to buy a lower market cap or more not very common currencies, then what you can do is you can use these stable currencies to purchase, like for example here, Mana and Cardano. You can use, just say you have Mana, you want to convert it to Cardano, you can sell the Mana and get USDT, and then you can use that USDT to buy Cardano again. So this is why stablecoins are very important. They are used as a common pair for most currencies. Bitcoin also is used as a common pair, but stablecoins are more stable, so people prefer to use this, and they increase the liquidity because if you want to convert from fiat currency to cryptocurrency, there's much more liquidity because everyone is converting this USDT or other stable currencies back to fiat currency. You're selling this for fiat currency. So to start trading, one of the first concepts you have to understand is technical analysis. So there are many specifics to technical analysis, like head and shoulders pattern and wedge pattern. But in simple terms, technical analysis is just studying the market patterns and the past actions. So for example, if you go here, every exchange will have this chart. This is just the value of the currency and how much is being sold over time. This is a one-day chart. So what technical analysis is the traders, people who use technical analysis, they will look at certain patterns in this chart. For example, let's search for a pattern here. So like for this pattern, people will see this and they'll think, oh, it's consolidating. And I'll not go into detail about this or here down here. So they'll look at these patterns, different patterns that are available for them, and they'll use even different indicators. So for example, these charts usually have indicators, like they'll have like a moving day average, so average of this chart and all that. So technical analysis is you use all these things you have, these assets you have to predict the market or to predict the price of the currency. It's not completely, even if you are very good at recognizing the patterns, it's not 100% guaranteed that you will get the predictions right. And there are some principles behind this technical analysis. Like the first principle is current price is the fair price. So traders who use technical analysis, they believe that the current price is a fair price because it's the price set by all these all the different financial markets, all the buyers, and all these people doing their own research. They came to this current price, so they believe the current price is the fair price, and they use the current price as a base for the analysis. So from here, will it go up or will it go down? So they'll use this current price. And second principle is price movements are not random. So they believe that the price of a currency is not completely random. It follows certain trends. So there are many different trends. I mentioned one, this wedge pattern on consolidation and all that. So I'm not going to, if you want to know more about these, it'll take a very, it's actually very it'll take a very long time for me to explain all the different patterns. So you can do your own research, and all the people have different opinions. It's very subjective. No one method of technical analysis is correct or incorrect. People have their own beliefs, and they use different techniques to make their own profits in trading. The next principle is what is more important than why. So these people who do technical analysis, they don't really go deep into the tokenomics or the fundamentals of a currency. They'll mostly focus on the price and the past movements of the price, because they are more focused on making short-term benefits. So they are more focused on the short-term fluctuations of the market. So they don't focus on the fundamentals of the token. They will do some research so that they don't invest in like scams and all that, but they'll not go very deep into this research. So this technical analysis is used in trading, and I'll tell you how. Like trading, first of all, I told you it's a short-term thing in this context, in the context of buying and selling cryptocurrencies and all that. When people say trading, they usually refer to the short-term buying and selling of currencies. And in this trading, price is everything. So, like I said, in technical analysis, you just focus on the price, you focus on the trends in the price, and you try to make profits. You try to make smaller profits. Even if it's smaller profits, you try to make more of it. And you can have, in trading, you can have multiple trades open at a single time. Even in a single day, you can do multiple tradings, or it can be within even a couple of minutes or hours, you can do multiple tradings, and you can buy and sell multiple things. So when you're doing trading, you're mostly focused on the short to medium term market fluctuations and short to medium term price movements. You're not really focused on the long-term growth of an asset, but you're more focused on the short-term fluctuations to make profits out of them. The risk with trading is you can miss out on long-term growths. For example, just say Bitcoin. If you're invested in Bitcoin early on, then the value of Bitcoin rocketed very highly. Went up very high and to a very large amount, and you can miss out on this long-term growth if you're just trading in the short term. So, and trading also has high time investments. 1 second, okay. Yeah, sorry. So high time investment. So you have to invest a lot of time when you're doing trading, especially you're doing shorter trading like scalp trading and all that, or different types of trading is there. So you have to keep checking the market and see the change in the market on a daily basis or even in an hourly basis. So you have to invest a lot of time, and there's higher stress. So there's more fluctuation in the short term as compared to a long-term market. So if you look at, let me give you an example. If you look at Bitcoin and you scroll out, the curves become much more, linear. It has a better curve like this if you go in the long term. So, but if you focus on the short term, you can see the fluctuations are very high. So it causes a lot of stress because in a matter of minutes or in a matter of seconds, you can lose a lot of value if you're doing trading. So the next thing is fundamental analysis. So in fundamental analysis, you can study the fundamentals of the assets. So for example, if you're studying Bitcoin, you look at the blockchain, you look at Ethereum, and you can check the Ethereum blockchain, what it's used for, the fundamentals of the asset, and what you're trying to do in fundamental analysis is you're trying to determine the long-term growth. So what will the value of this asset be? Not tomorrow or day after tomorrow or something like that. You're more focused on what the value will be months or years from now, and so that you get a large return at the end of the investment. And you're focusing on things. You're trying to find out reasons that for the growth, like reasons for why this currency is going to grow in value. You're trying to focus on the tokenomics, like I explained before, and the underlying technology, the blockchain. You're focusing on, especially in the cryptocurrency, you're focusing on the blockchain of the currency that you want to buy. So when you're planning to buy a certain currency, you have to do all doing fundamental analysis is very important. You're not going to do day trading, and you're going to do investing. So not only that, you have to study the business. So you have to study the owners of the creators of the blockchain, or the creators of the token, and you're trying to evaluate. So you're trying to see if it's at a good valuation currently. So, or if it's undervalued. If it's undervalued, then you can buy it at a good price, and you believe that the value is going to increase. So this fundamental analysis is not used in trading much. This fundamental analysis is mostly used in investing. So you can either find a good currency and you can study about it and truly believe that it's going to go up in value and buy a lump sum amount at one time, or you can do what is called dollar cost averaging. So this dollar cost averaging is a long-term strategy where you use fundamental analysis to find the right asset or the currency for you to invest in. So how do you do dollar cost averaging is by, for example, lump sum investing is also possible to do long-term investing, but most people don't have a lump sum amount. And what most people have is a salary. So what you can do with a salary is every month when you get your salary, you can put a percentage into the asset you have researched and the asset you want to buy. So that is what dollar cost averaging is. And you're price agnostic. So that means it doesn't matter what the price is. Every month when you get a salary, you just buy the asset. So you're just accumulating the asset and growing its value. And this dollar cost averaging is not trading, it's an investment technique, and you're not interested in the short term. So you're not gonna do dollar cost averaging for 1 month, and it doesn't work like that. So dollar cost averaging is for the long run and to see the growth in the future. And it has a low time investment because the only investment of time you spend is when doing the fundamental analysis and researching the things you want to buy. And other than that, when you're gonna buy, you just purchase the asset every month. And also another investment of time is you have to keep track of the asset you're buying. You have to keep track of the owners. For example, if you're in I'll talk about that here. So you're more focused on the long-term growth of the market. So what you're betting on is you're buying more and more of these assets every month, and you're betting that the value of these assets will go up high based on your fundamental analysis. So based on what you studied and what you think the business is going to do or the currency is going to do, and you believe that the creators of these blockchains they have a good idea and they have a good history, or they have a good plan for the currency or something like that, then that's why you do dollar cost averaging. It's low stress because you're not focusing on the daily fluctuations of the market. Like I said, the market in the short term is much more volatile. So when you do these long-term types of investments, you have less stress and you're not checking the market constantly. So some downsides of this dollar cost averaging are there's no mathematical advantage compared to lump sum investing. So some people might say like dollar cost averaging is actually a good technique, but if you have a large amount of money at once, you can still directly invest. That's still a very good option because, for example, when a currency is going in an upward trend, let's go back to this page. So this is a day chart. Let me get, so here, just say you purchased Bitcoin when it was at this level. So this was around 31,000. This is around, yeah, around 30, just say around 30,000 USD. You purchased a lump sum amount here. So if you purchased a lump sum amount here and then you cashed out in the stock, you would make much more profit than someone who just dollar cost averages and purchases here time, every month he gets money and just keeps on purchasing the amount. The Bitcoin, the person who buys lump sum will have much more profit. So there's no advantage to dollar cost averaging compared to lump sum, but dollar cost averaging is much more convenient for most people because they have a salary and salary is just monthly. They have a monthly salary. And another risk is the risk of large losses. So here the risk of large losses comes from the fundamental analysis. So when someone doesn't do proper fundamental analysis and just invests in something due to hype, then there's a chance that that coin might drop in value or be completely valueless as well. And also another thing, you have to keep track of your assets, keep track of your investments, and so keep reading the news and all that about your assets so that if something happens, like for example, let's say XRP, or let's not take a specific coin, for example, but let's take just say a random coin. The founder of this coin goes through some legal problems and you find out that, or he's holding multiple wallets, or something like that, and things like that. You don't see that in the news, and you don't keep up with the news. Then there's a risk of you losing a large sum of money. So now we're going to go into the details of how to trade. So so when you open a page to do trading, you'll see these are all these different things, and you might be intimidated by them, but I'll show each element differently. So right here, we're going to talk about this. So I'm not going to use this page because it's moving and it's hard for me to explain. So I took a screenshot yesterday and I just uploaded it here. So this is called the order book. So what the order book is, it's just a list of orders. So these are people, these are a list of people who want to buy Bitcoin. So I took a screenshot of the Bitcoin Tether order book. So these are a list of people who want to buy Bitcoin, and this is the offer. So they want to, for example, this person, he's willing to buy Bitcoin at 39,458.19 USDT, yeah, Tether. And he wants to buy the quantity. He wants to buy 0.003 Bitcoin. So this is the quantity he wants, and this is just the multiplication of this. This is just the total amount. So yeah, and this is the latest value. So this is the one which was sold recently, and this here is the sellers. These are a list of sellers, and these are all the people that are willing to sell. So usually what happens is the people in the buyers, they usually want to buy at a lower cost than what the sellers are willing to buy. So if you look down here, these sellers down here, they're asking for a higher price. They want to sell for a higher price, and the people up here are selling for they want to buy in a cheaper price. So usually what happens is these two people here are the ones who do the trade. So they are more closely close to what the other person is asking. So another thing is called the spread. So spread is nothing but the difference in this. So in this screenshot I took, the current value of Bitcoin against the Tether is 39,458.19, and not the current value. The person willing to pay is this much, and the person who put up his own Bitcoin to sell is willing to sell it for 39,458.2. So the spread or the difference between these two is very close. So it's just 0.01. So it's very tight and very close, which is a good thing. So traders, they'll look at this. If the spread is too far apart, then it's not a good thing for them, because say you want to buy, you have to buy, this is the best offer you can buy it at, and if you buy it and the spread is very high, then once you buy it, to sell it, you have to sell at a bigger loss because the amount that people are willing to pay is much lower. So traders, they want the spread to be very tight. The next thing is market order. So again, I'll go to our trading website. So this is the market. This is where you can buy and sell. This is where you put the order. So I'm gonna look at the slides again because here the things are moving around and there might be a little bit of lag, so it might be difficult to follow. So in market order, it means you're planning to buy Bitcoin. So you already have Tether, you have a USDT, and you're planning to buy Bitcoin. So you can buy through a method called market order. So what this means is you choose how much you want to buy, but you don't pick the price at what you're planning to buy. Instead, it just automatically purchases the latest price, the last price in the market. But for example, if you want to purchase one Bitcoin, you put here one in the quantity, you put one, and you purchase one Bitcoin on the latest value. So, but there's a thing. If you look at this order book, you'll see that they're not selling one. So this person is selling 0.1. This person is selling 0.04. So if you order one, you'll not only get the price of this, not the lowest price, but also you'll get this and this as well, because to fulfill your order of one Bitcoin. So the pros and cons of market order. So buying Bitcoin through market order. So I'll just show you. This is market. You go here and you just put on the quantity. I want to buy one Bitcoin, and you can just buy it from here. I'm not logged in right now, so I can't show you, but yeah, you just press here and you automatically buy. So the pros and cons, the pros are it's very fast. So as soon as you press buy Bitcoin, it'll automatically be purchased. And it's very simple. So you don't have to worry about all the different fluctuations in price. You just press it and you'll buy it. It's a guaranteed trade. So as soon as you press buy, you're guaranteed to get the amount that you ask for, unless there's none in the market right now, not enough, then maybe you will not be able to get it. But if you buy it, you'll purchase as much as you can, even though it's different costs. It'll just add all these different quantities and try to get the amount that you're asking. The cons are you're on the wrong side of the spread. So when you do market, you're not asking for a lower price. So you're not making your own price. You're not asking for a lower price. Instead, you're complying with the sellers and purchasing at whatever price they are selling at. The next method of purchasing Bitcoin or doing trading is through limit order. So in limit order, instead of selling at, you pick the amount. So you can so you choose the amount and you choose the price as well. So yeah, I'll show you. So if you go here, so if you go here, you can go to limit, and you can you can choose your amount. So just say I want to sell I want to purchase Bitcoin with Tether at 35,000. And you want to buy one. So if you press buy, then you'll have your order will go up here in the order book, and it might not get executed because you're asking for a very low price. You want to buy it at a very low price, so most probably it'll not be executed, but your order will be placed and it'll be up here. So what are the pros and cons of limit order are? The pros is you get a good price. So you choose your own price, you might get a lower price. So when the market is fluctuating, if it comes down and reaches your order price, then you might you have a chance of getting a better price. And you choose how much you want to spend, right? How much at what value you're gonna buy. The cons are the trade is not guaranteed. So for example, I asked to buy in with 35,000 Tether, and if no one is willing to sell their Bitcoin at 35,000 Tether, then my order will not be executed. And for example, if somewhere around here, I want to purchase it here, but the market doesn't go down enough for me to purchase, then I might miss out on uptrends like this with the value going up, and I won't have any Bitcoin to sell. So that's the risk of limit orders. The next type of method of purchasing is stop market order. So stop market order, we don't currently have in our spot trading. We have it in futures, but I'm not going to go into futures right now. So I'll just show you here. So in stock market, what happens is you put a trigger. So you put an amount, a fixed amount, a trigger. So you can see here stop price. So when the market reaches, when the value of Bitcoin, goes up and down and it reaches that trigger, then it'll automatically sell your or buy your order. So just say in quantity, you say you want one quantity, and you say you want to sell it at a certain, you want your stock market, your stock price to be a certain, just say, here it's 39, right? You say it's 38,000. So if the market goes down and reaches 38,000, you automatically buy the one Bitcoin with all these different orders. They'll try to fulfill your order. So stock market is good because once a trigger reaches once the market reaches the trigger, it'll guarantee buy your asset. But if the market doesn't reach your trigger, then it will not purchase. So it's not a guaranteed buy if the market doesn't reach your trigger. But if the market reaches the trigger, then it's a guaranteed buy. So let's take an example here. So you put your stop marker here. So this is your sell stop marker. So when the value of Bitcoin reaches 48,000, you want to sell it. So what happens is, just say you bought it at somewhere around here and you want to sell it. So what happens is, if the value goes up and touches this point, then you automatically execute your order and sell the Bitcoin at market price. The next method is stop limit order. So in stop limit order, you choose the amount you want to sell and the price you want to sell it at. And also you place a trigger. So like this in the stock market order, you have a trigger as well in this stop limit order. But in the stock market, it automatically buys whatever it's there in the order book, right? But in the stop limit, you don't automatically buy. Instead, you put a value. So here you can see in stock market, there's only two options, right? Stock price and the quantity. So it doesn't have an option to tell you how much you want, what value you want to buy your Bitcoin at. But here in the stop limit, it has an option for you, the price. So what you do is you set a stop price. Just say you want to buy it at 38,000 when it reaches 38,000. But you want to buy when it reaches 38,000, you want to buy it at a different cost. Or if you just say you want to sell your Bitcoin and you want to sell it when it reaches 40,000, but you know that it might go down soon after it reaches the 40,000. So what you do is you say once it reaches 40,000, I want to sell it at 39,990 or something like that. So that your order will be more likely executed. And especially if you're selling a large amount, if the market reaches your stop order, if you're selling a large amount, then you might crash the market. So you might not sell everything that you are wanting to sell. So you can do that. So let me show you. The another type is stop. There are two types of stop limit orders. So one is stop loss, and the other one is take profit order. So just by looking at the name, I think you can understand stop loss means to stop your losses. So it lowers the amount of your risk. And so when you're doing stop loss, it has to be below the current value. So let's see here. This is the current value of Bitcoin in this chart. This is taken, I think, yesterday. So this is the current value. If you want to do a stop loss, then you have to put the stop loss below the current value. So what stop loss does is it stops you from getting any more losses. So if the value of Bitcoin goes down, reaches here, instead of losing more money as it goes down, you automatically sell off your position here and you lower your losses. And take profit is the opposite. So take profit, it has to be higher than the current value. So when the price of Bitcoin reaches this point, 48,000, then you automatically sell off your Bitcoin. Not in the market price, you put a you choose whatever amount you want to do, and that's how stop loss and stop profit works. So in these charts, you must have seen this candlestick chart. These are the candlestick that you see in all these different charts. So this, I'll just tell you a basic way to understand what these mean. So these are mostly used not by investors. Investors don't bother with these things much. It's usually by traders. So if the candle is green, that means this is the one in the bottom of the rectangle is open. So this is the price where these candlesticks can be any amount of time. You can pick, you can make it 1 day or 5 minutes or 15 minutes. So I'll just show you. So it's up here, the option to change the candlestick time value. So right now it's 1 day. So each stick right now is 1 day, 1 day's worth of trading. And you can change it here. You can make it 1 minute, 3 minute, 5 minute, any time duration you want. And how do you read this? So when it's at the bottom, when it's green and the bottom part of this rectangle is called, it's the open price. So this is where the value of the currency was started when this day started. Let's just take, for example, this is 1 day candlestick. So these lines are just the activities that happened that day. So the value of this currency went down to this level, went up to this level. But at the end of the day, it closed at this level. So this is the closing level, the upper part. So if it's red, it's called a bearish. So like the word bullish and bearish is being used here again. So when you see a red one, it's called a bearish candlestick. So in a bearish candlestick, the opening price will be the one on top. So the top of the rectangle. And just like before, this is the activities that happen throughout the day. And the bottom part of the rectangle, it's the closed. So mostly this is used by the traders, not by investors, to predict and to make certain patterns. So there are different patterns. I'll just go through two. There's multiple ones. There's engulfing patterns and all those also, but I'll just go through two of the most simple patterns. So example, this is the hammer pattern. So let's take, for example, here. In this hammer pattern, what happened? So like I said, if it's green, the opening price is the bottom line, right? So what happened was it opened at this price, and the value of this currency went down. So right now I'm using the chart not for cryptocurrency. This is normal currency, forex, but I just use this chart because I couldn't find any other pictures. And so you see this thin line right here. This is the activity throughout the day. So the sellers, what happened was the sellers dropped down the price. So people started selling more and more of this currency, and it dropped the price down here. So, but at the end of the day, the buyers were able to drive up, the demand went up, or the buyers started buying more and more, and it pushed up the value back up to above the opening line. So it went above what the opening value was. So what you can see from here is the buying pressure outperformed the selling pressure. So in this hammer pattern, it's a bullish pattern because the traders, what they do is they use this pattern to say that there's a momentum going on. The buyers are gaining momentum, and they predict that the market will go up more. The next pattern is shooting star pattern. So it's opposite of hammer pattern. The line is at the top. So in the shooting star pattern, it's a bearish pattern. So the traders, they use this pattern to predict that the market is going to go down. So why they believe the market is going to go down is because most of you must be wondering why the red ones are also there. So even the red ones are considered hammer because the thin line is at the bottom. And what that means is, of course, the value is that of this currency was lower than what it opened with, but it recovered. There was a big momentum. So the price dropped a lot, but the buyers, what they did was by the end of the day, they started purchasing a lot, and they drove up the price back up to a very good value. So there was a momentum. So it might be, obviously the value might be lower than what the opening value was, but if you see this line at the bottom, it's still a very bullish thing because it means that there's a at the end of the day, there was a momentum of buyers, so people started buying a lot. So you can see a lot of these patterns. You can see after this hammer pattern, there was a big uptick. Even after this hammer pattern, there was a big uptick. Here also there was a big uptick. So people, traders use this type of different techniques to predict the market. So the next one, the opposite of the hammer one, is the shooting star. There's another name for this, but I forgot. So shooting star, the thin lines on top. So this is a bearish pattern because what it means was because the during the day, during the trading activities, the buyers pushed up the price, but at the end of the day, there was a big sell-off, a big momentum sell-off. Maybe a large amount of sellers sold a lot of their holdings, and it dropped the price down. So even if this is green, the line is on top, right? So it means the opening price is still lower. So the price, say the Bitcoin opened at 40,000, and at the end of the day, it's worth 41,000. So it went up in value, but this shows the activity throughout the day. It went up in value, but the momentum that happened was there was more buying towards the end of the day. So probably the next day there'll be more momentum. The momentum will carry. So this is some of the patterns that people use. There are other patterns as well, but I'm not going to go into those. And there's even patterns with the charts. There's like head and shoulders. There's consolidation. There's wedge pattern and all those. And you can use different methods to and research on your own time. And these patterns are very. Some people don't believe in this patterns in this trading and all that, and some people believe it wholeheartedly. And some people hate certain patterns, and some people love certain patterns. So it's up to you. You do your own research and you come to your own conclusion, because I'm not giving any financial advice. This is just education, and for you to understand existence of these things, so you can make your own opinion. Go and do your own research in these things. And because if I start talking about all the different patterns and how to read them, it's going to take a very long time, and late today I don't have much time. So spot trading. So if you go to our website, this right now what I'm doing is called spot trading. So there's two types of trading in our website. In our exchange, you can see spot and futures. So what I was showing all these things was on spot. So what is this spot? So spot trading just means it's on the spot trading. So you can instantly exchange coins for one another. There's other things like futures trading as well, but I'll not talk about that now. So in spot trading, you just do on the spot trading. So you can either place an order. If the order is executed, you'll get your order on the spot. Or if you want to sell something and your sell order is executed, it will get sold on the spot. So it's like a direct exchange between people, and there's no intermediaries. It's just directly exchanging with each other. So after learning all these things, the different techniques, everyone has a different, is suited to a different method. For example, some of you might be more interested in this dollar cost averaging. Some of you might be more interested in day trading. A lot of the students are more interested in day trading, but investing also is a very good option. And what I would recommend is people who are planning to invest and you don't want to worry about the short-term things, you focus more on the fundamental analysis. And people who want to do day trading and all those things, they want to make profits now, and they want to look at the market and have a chance of making big profits early. You can check more into this technical analysis, and you can study more about the different techniques that traders use. So you can implement techniques that even stock traders use. Most of these techniques are similar, and you can build your own opinion, because this is very subjective. Most people have arguments about this. They believe in investing rather than trading, and some people say no, there's always a pattern behind everything, and there's a method to the madness, of the charts, and you can find ways to make profits, and it's actually something that's not just luck based but skill based. So now you want to know how to start trading. So you can start trading through exchanges like ours. So first of all, you open an exchange account buy stablecoin, I'll just show you later on, but I'll just go through this now. You find the cryptocurrency you want to invest in, find the trading pair, and you start investing. So this, you can use our website, our exchange. We're releasing a mobile app as well. So if all of you can go and register for, pre-register for it, it's going to be released soon. So I'll just take you step by step of how to start trading. So first thing, what you do is you go to our exchange, our website, and you can make an account. So after you make an account, what you do, you log into the account, you do some verification, and then you go here and you buy with INR. So you can convert your fiat currency, your rupees, to Tether stablecoin. What you do is you buy it through, you have online payment methods. You can purchase, just say you can either say you want 5,000, you want to deposit 5,000. So you'll get 60 US Tether. So this is just based on the value of US dollar. So this is the value of the US dollar against rupees. So if you invest, deposit 5,000, you'll get 60 USDT, and it'll be, once you log in, there'll be an option here. It'll say wallet down here. It'll say wallet. And what you can do is, after you purchase the stablecoin USDT, you go to spot here. Showing differently on my monitor and on the stream. So yeah, you go to spot here, and what you can do is, like I taught you, you can go here in this. So you can either go to limit, or you can go to limit, or you can go to market and purchase Bitcoin. So after you buy the USDT, you go up here to find the trading pair. So you go up here in the top left corner, you'll see 3 lines, the options. You open that and you can type and search whatever you want. So just say you want to buy Ethereum, you can write ETH. So this ETH and BTC, all these things, these are called tickers. So tickers are, it's like short forms, it's been taken from the stock market. So in stock markets, you see in movies and all that, when they're doing trades, you see that symbols moving around the building. So those are the tickers. So that's just letters that depict a certain, crypto or whatever. So for Ethereum, it's ETH. So you can see the different pairs. So you have an Ethereum Bitcoin pair. You have all the different pairs. So what you have to do is, since you bought USDT, you first type USDT. You can see all the different pairs for USDT. So you want to buy Bitcoin. So you can press this BTC, Bitcoin, and USDT pair. Press this. Then the charts will show for this pair. The charts and the order books, everything are for this pair. And if you buy here, then it'll be for this pair. So you see right here, it's written USDT 0. So if you buy USDT, it'll show here how much you have. And this is the price. You can type how much, what you're willing to pay for Bitcoin, and you can buy the amount. So you can use the slider to, it's like percentage. So you can use all these different methods, and you can use market. Market is much more simpler. So you can just put the quantity down and purchase. And once you purchase, it'll go to your wallet. So like I said, we have to log in to see the wallet, but it'll be up here. It will be written wallet up here next to spot and futures. And you can even sell easily. So you can sell it here. You can sell it at market price, or you can sell it at limit. And what you can do is, you can start using the different techniques. Investors can just do dollar cost averaging if you want. Day traders can start learning more about the different techniques that traders use and start playing around. And I would recommend just invest a little bit of money in the beginning. First, put a little bit, so that once you're financially invested, you get encouraged to learn more, right? So for example, what I did was, I was very lazy to learn more details about this cryptocurrency and how these things work. So what I did was, I took a little bit of money and I just invested it in an exchange. And that encouraged me to check on my money every day and helped me understand more. So when prices went up, I didn't really study much, okay? So when prices of Bitcoin and all that went up and I had profits, I didn't really care. But once I started having losses, that's when I started doing more and more research. and trying to understand why am I losing money and how can I not lose money. So I would recommend all of you to just invest a little bit in the beginning, just so that you're invested, so that you are encouraged to learn more about it. And I'm telling you, there's not, the biggest encouragement you can get in the beginning is a big loss. And, some people will take it, will be discouraged and leave the market, but if you are really interested and you believe that, yeah, I can make money here, and then when you have a loss, then you will be more encouraged and driven to find out different methods to not lose money in the future and to actually make a profit. And like I said, especially for students, crypto trading is much more convenient because you don't have a opening and closing time, and you can do it at night, you can do it at any hour of the day, and it's open during weekends as well. And so I think that's all I'm going to talk about today. I have another appointment, so I'll have to stay a bit longer. Is Saswata here? Um, let's see. Um, so hopefully
Yes,
today,
hello.
yeah. So I'll be done with my session now. If you can teach a little bit about futures trading, if you're interested, or you can answer some of the questions that they have. I have another appointment. I'm sorry, so I'll have to leave soon.
Yeah,
But
sure. So, guys, do you have any questions for Lekha before he leaves? Hello, guys. You there? You want to mark for attendance, right? You don't need to do it. Like, okay. So, I think I'll take over the session for now.
okay. Yeah, so I will just
Lekha.
say something. Hopefully, some of you get encouraged to start investing and start trading so that it's a good source of income and actually a great way for students to learn about how the financial system works and how to handle their money. So thank you everyone for giving me your time, and hopefully I taught some of you something at least. So thank you and have a nice day.
Thank you, Lekha. Okay. So, guys, answer a few basic questions for me. So, what do you people, first of all, what do people learn about stock markets? Or what do people learn about um, crypto markets? What are they? Share markets, stock markets. What are they basically? Any answers? Any answers in the chat? What is a stock market, guys? I don't need to worry about your attendance, right? I know universities are really very strict about attendance, but we are not so. It's not so very strict about attendance. Guys, so what is the stock market? You people learn the entire like the spot trading, the way to predict the prices going up and down. Any answers? Yes, no, maybe.
It's a place where we can invest our money.
Okay. You want to invest your money. So, for example, you're buying something from the shop. Okay, you're investing your money. You're getting the goods, your goods in return. So, how is it different from stock market? You're investing your money for some goods, right? Instead of while buying stuff from from some stationery shop or grocery shop. So how is that investing different from this investing?
Buying stocks can lead to profit or can be loss. Money can be increase, decrease, but buying goods, it's a commodity thing.
Okay, so for example, I buy stuff from the wholesale market and sell it as a retail, sell it at retail price in the retail market. So how is it different from stock markets? I'm
I
like,
should answer the.
yes, Rajat.
Yeah. Basically, it is different from the buying from the wholesale and selling to the retail, cause it is not necessary that we will find the buyers. But in the stock market as it is going on, if except some shares, those are declining very much, we will find the buyers to sell at each time.
Okay, yeah, wonderful answer. Though I won't say it is the answer I was looking for, but I appreciate your point of view. That is one point of view to be reckoned with. So I will present my screen and let you know what actually a stock market is. So why do you think stock markets exist in the first place? Like people buy stocks, right? It is as simple as that. People buy stocks. Why do people buy stocks, and which stocks people buy? Or people buy stocks of those companies which will give them profit, right? Which will fetch you profit. For example, stocks of Google, it will fetch me profit. It's as simple as that. But stocks of something like Yin Yang company, I don't know if this company exists, but of course it won't fetch me profit. It's an absolute cross. It won't fetch me profit. So, what are the companies that can participate in the stock market? Do you guys have any idea? Like, which companies are enlisted in the stock market? How are they enlisted in the stock market? So, for example, if you are starting your own company, how are you going to enlist your company in the stock market? What are the procedures for it? Wait a second, I just it's 7% charges only there. I'll just plug up my computer and then return back to you. 2 seconds, guys. Okay, so guys, am I audible?
Yes, sir, you're totally
Yes.
audible.
Okay, so did you come up with an answer to my question? Like, how can you enlist a company in the stock market? Like NSE, people must have heard about NSE, National Stock Exchange, Bombay Stock Exchange, BSE. Okay, so how are you going to enlist a company? For example, you found your company XYZ. You are the founder of your company. You want to enlist your company. What are the what is the like minimum requirement, or what are the procedures with the help of which you are going to enlist your companies in NSE or BSE? Do you guys have any idea? So see, if since you people are not answering, I will assume that you don't know. It's not a problem at all. I'm here to tell you. So a company, for example, Google. Okay, this company is going to uh, make a lot of projects, right? These projects will require a lot of funds. Funds, bole to money. पैसा मांगता है, ठीक है. So they require money to do their projects, but they don't have sufficient money on their own, or investors. Like Google is now worth a few $1 billion. No investor is going to invest, not one single investor or multiple investors are going to invest on like such a huge amount in one single company. They're going to invest in multiple companies. Like investors usually invest in millions, not in billions, or 25 billion, 50 billion. They are not going to do so. Like there are really very few investors in this world who are actually billionaires, like super billionaires. They are not going to invest more than 75% or 50% of the portfolio in one particular company, right? So how are they supposed to increase their funds when the investors are the funds of investors are not sufficient to do so? So what do? They distribute their company's ownership. What do I mean by that? Stock market. So how did I relate? I know you people guys must be confused. So for example, my company is $100 million company. Okay, the asset value. This is known as the asset value. The value of my company, entire value of my company is known as the asset value of the company. So my company is $100 million company. So not my company, Google say, for example, $100 million company. So how I'm going to distribute the company's ownership? So how will I do it? So for example, I create a $1 million bill, 100 $1 million bill, $1 million bill, or you can say stock. Okay. So, and I go to NSE and BSE, NSE or BSE, and then ask them, please sell it. Please uh, post this particular advertisement in your order book so that people can buy. So what will people see? That $1 million stocks are available for Google. Okay, so I'm sorry, Google cannot enlist in NSE or BSE, but this is a hypothetical situation. Just cope up with me. Whatever it is. So what what do I do? I buy one stock worth $1 million, and I become a partial owner of Google. So in return, what is Google getting? Those $1 million which I used to buy the stock. Google is getting this money. So by distributing the company's ownership and making partners, absolutely random partners, by making them public, what I'm doing, I can raise the company's funds and I can do as many projects as possible. So if the worth of Google is $100 million, after acquiring some of the funds, they what do? They complete their projects and they become a $200 million company. Okay, they become a $200 million company. But I have one stock that is worth $1 million. Okay, that was worth $1 million. Let me rephrase my statement. Was worth $1 million. Then the company became $200 million company. So my value should be doubled. So my stock should be worth $2 million now. Okay, this is the present value. What is my profit then? Profit margin. My profit margin is 2 minus 1 is equal to $1 million. Are you getting all this?
Yes.
Okay, wonderful. So this is what a stock market basically is, where a company enlists in um, some of the some of the entities like NSE, BSE, or New York Stock Exchange, NYSE, and they raise their funds to do their own projects. Okay, and in return, the company, the one who has bought the stock, is also under consideration for their own profit. Like, why would you invest in a particular company? You know that company will prosper. That is the reason why you are investing. If you think that company is not going to prosper, that company is going to fail, why should you invest in that company? So what is the work that you're doing? You're predicting. This is a very important word in stock market. Predicting that the company will rise or the company will prosper, whatever it is. So your job is predicting and buying. The company's job is its job. Like Google's job is it is an it is a IT sector company. Like it is a project based company. You people know what Google does, right? But mm, Tata job is something like a different. It's service based. It is a service based company. Goldman Sachs, it has a different purpose. So you must research about a company. You must think that okay, fine. 5 years from now, 1 year from now, that company is going to prosper, and you are going to invest in that particular company. So you are investing in a company in which you think that company would like that. You know that company is going to prosper. So this is one kind. And now, how many of you just tell me have seen Scam 1992?
Not completely, up to fourth episode only.
Okay, what about others? Amardeep Ranjan has only watched it. What about others?
So I also started but confused.
Okay, so two guys.
The terms used in that scam 1992 are going out of my mind. It's not
Okay, okay,
understood.
okay. So I'll try to make it as easy as possible, but I first need to understand that only two guys. What about others? Like Yash Mohta, Ayman Asha, Vedang Chauhan. What about you guys? Are you all sleeping? Komal Singh, Navneet Beral, Prince Maurya, Ronak Jha, Subrajit Paul, Suman Karmakar. What about you guys? I are you all there? I know this might get really very boring, like finance and stuff. You guys are computer science students, I guess, right?
No, I am from MEC.
You're from Mech. Oh, that's nice. People are getting
I'm
interested.
also from Mech.
Okay, electrical. That's nice.
Yes, sir.
People
Actually, they are
from.
various branches, from mechanical,
Okay,
electrical, CS.
okay. So people from all over, from every kind of field is getting interested in crypto. That's interesting to know. So uh, finance is something that you might not be familiar with, or you might be familiar with. I don't know. But Scam 1992 is something which will make you familiar with the world of finance for sure, and it is done in a very beautiful way. But some of you who do not have the basic knowledge of stock market, or the basic knowledge of like what a futures marketed, you might have some problems. I agree. Like it's not really very simple and gullible for each and every person out there. It's a little bit complicated. So the best thing of Scam 1992 is how they explained long and short positions. So long and short positions is basically what they explained is like long bole to bulls and short positions bears. What do I mean by this? Like price goes up and down. So for example, my Google is $100 million company now, but 2 seconds later it might be 99.2 million dollar company. Okay, $1 million company. Google just suffered a loss because a client rejected a project of it, some like 80k, $80,000. A client rejected a project, or one of the labs of Google got burned because of Osama bin Laden's son. I don't know. I'm just guessing. So whatever it is, so a company's price and valuation is not limited, or is not going to go in one particular direction. It can go up, it can go down. So if it is going up, we know that if it is going up and I'm investing in that particular company, I'm going to make profit. But isn't there anywhere other round? Like if the company is going to go down and I know it, look, okay, and I know it, and I want to bet on that, so isn't there any option available? Isn't there any option available that okay, fine, I know that company is going to go down, I know that company is going to be worth $90 million in the next 2 days, and I want to bet on that. I want to bet on that. I want to bet on that. So I'm predicting, right? And as far as I know, predicting is stock market. Predicting is the entire game is of prediction. So I am predicting right, but there isn't any other option available. It is because only when price moves up I make profit. No, absolutely not. In case of futures market, you are not buying the stocks, literally not literally buying the stocks. You are gambling. Yes, this may sound really bad, but basically futures trading is gambling. So you are predicting that the company is going to suffer a loss, and you are going to bet on that. That is known as a short position, shortening of the position. This is what bears do. What do bears do? They have claws, right? With the help of their claws, they can, like, वो पंजा मारेगा तो प्राइस नीचे आएगा. This is the exact dialogue of scam 1992. And what is the dialogue of bull? Like, what dialogue did they use for bulls and long positions? It is very simple. Bulls, they have like horns. So जब एक bull सींग मारेगा तो प्राइस ऊपर जाएगा. ठीक है. So that is a really very beautiful mnemonics that they used to help the people remember such stuff. So long position is for bulls. Like, they are known as bulls. The people who play long positions, they are known as bulls. The people who play short positions, they are known as bears. Price goes down, and you make profit. Price goes up, and you make profit in case of long. Price goes down, you make bears make profit. If price goes up, bulls make profit. Harshad Mehta was a bull, the hero of scam 1992. If you people don't know, 1992 scam 1992. Harshad Mehta was a bull. So what he used to do, he used to open long positions, and bet on the fact that the company is going to rise. It is as simple as that. So this is what long and short positions is. So, and this is what futures market is. So in futures market, you don't literally buy a stock. In futures market, not literally buying the stocks. What do I mean by literally buying the stocks? I mean you are the partial owner of the company. But in case of futures market, you are not the partial owner of the company. You are betting on the fact that the price is going to go up or the price is going to go down. So what is the first advantage is that you can bet that the price is going to go down, the short position, which was not available in case of normal stock market. What do I mean by normal stock market? It is the stock market which Lekha just taught you. Okay, uh, that is normal stock market. That is spot market. Normal stock market is also known as spot market. Normal stock market is also known as spot market, where you buy everything on the spot. But futures market is a little bit different. Futures market, first of all, you are not a literal owner of the company. Second, you can bet if the price will go down. Okay, these 2 points are covered. Does anyone have any problem? Like, it is really very tricky to understand at first, because it is a little bit complicated and a little counterintuitive, and that is the reason why many people don't understand scam 1992. I'm trying to teach you web series, guys, please. I'm
Yeah,
literally
if
discussing
I
a web series.
don't have any share right now, stock right now, then how I can sell that?
If you don't have any share right now, how you can sell it?
Yeah.
Okay, you are not selling the stock. In case of futures, you are not buying the stock or selling the stock. Then how are you making the money? You're betting. You're betting in terms of a contract. Okay, so whenever you are placing your bets in future, so for example, if I go to try units now, and go to futures, I guess I'm not logged in. See, in case of futures, you see open long and open short. Okay, but in case of spot, what do you see? You see buy BTC. Okay, so you get the difference. The difference between futures and spot is you're not literally buying the stock or selling the stock. You're betting with the help of a contract. So in the contract, what is written? Contract, opening of contract, like opening of contract. So a contract has a few terms and conditions, right? So I will be listing down the terms and conditions now. So the first terms and conditions, what is it? uh First terms and conditions is, so for example, I go to futures now. First terms and condition is what price I am buying at. So if I place open long over here, you can see that the current price 39,340, this price is going to get into the contract. So the current price of any stock, of the stock that you are placing your bet on, current price of the stock or coin, since we are studying about coin, crypto markets. Basically, the crypto markets are based upon the stock markets. It is an underlying derivation of the stock market, nothing else, using blockchain. Current price of the stock, sorry, price of the stock or the coin that you are placing your bet on. And secondly, what is it going to, the terminating condition. Terminating condition. This happens in case of a perpetual futures trade only. I'll get to that, what is a perpetual futures trade. But just remember, terminating condition is required. What is a terminating condition? Like for example, the price goes up, okay, and you are placing a long bet. So the price now is 39,300 something. The price goes up to 4,500. Okay. So what is the terminating condition? Like closing price is as predicted. What is predicted? Oh, so sorry. First, let me tell you what kind of position. Long or short. Okay. So this is a really very important factor that you need to know, that the contract needs to know, right? The contract needs to know what kind of bet you are placing, long position or short position, what kind of play you are going to play, whether you are a bull or whether you are a bear. Contract needs to know that, right? And the contract needs to know what is the closing price or the terminating. Now comes the terminating part. Terminating condition. Okay, so if you place long, if you place long, the computer science students are going to get really very familiar the if and if else statements. If you place long, then what will happen? So for example, the current price is say $39,000 for BTC, 39K, and the and you placed long, right? So what do you mean by long position? Long position means you are predicting that the price is going to go up. So if the price goes up to say um closing price, say $40,000, say $40,000. Okay, so closing price say $40,000. So what is the profit that you will make? 1K. If you play with 1 BTC, all right. Now if you play short, if you place short, what will happen? It will simply be the opposite of what I just did for long. So the current price, what did I say? $39,000. $39,000. Closing price goes to $38,000. But I have placed short, so I have predicted that the price is going to go down. So I'll also make a profit of 1K. Did you understand this part? Anybody having any problem regarding this particular part, please let me know. It is because this is really very important. The terminating condition. Then I will go how will you lose your money. This is the profit making part only. Is anybody having any problem if you place long and if you place short? Is anybody having any problem? Yes, somebody opened his mic.
Understood.
Understood. Okay, fine. So now this is only the profit making part. What if the price goes down to $38,000 when you are playing long? So you predicted that the price is going to go up from $39,000, but the price went down to $38,000. You are not going to make any profit. You are going to suffer a loss of 1K. Understood? Similarly, in case of short, if the current price is $39,000 and the closing price is not 38 but $40,000, so you are playing short. That means you predicted that the price is going to go down, but the price went up. So you're not going to make any profit. You're going to suffer a loss of 1K. So this is how future state basically happens. I'm not going to go into the intricate details of how a futures plan or project works, because that is really very difficult. So you can see a lot of complicated stuff going around here, like 24H change, index price, mark price, funding rate. Now, funding rate, this itself is really very complicated. Like, I designed futures with my own hands, and I found out that the mathematics which was required to calculate this funding rate is so very complex that unless you are a PhD in economics, you are not going to solve it. Like, the intricate details of futures is really very complex, but the way to use it is really very simple. It's as simple as, I'm going to refresh the page. Is as simple as, this is the current price. How much quantity do I want to buy? Like, this is the amount of quantity. This is the quantity I want to buy, right? 45. Do I have money in my account? I don't have. Oh yeah, I do have. Yes, I have a couple of $100. I have $100 in my account. Wow. So, for example, if I want to place 20% of my portfolio into the long position, okay. So I don't know whether the price is going to go up or down. I'm just going to make a tutorial. I'll give you a tutorial on how to place a futures bet. So I just selected 20% of my portfolio. Okay, my portfolio is $109.5. I'm going to open long position. I place the bet. I guess it's done. Oh no, I didn't click. I'm going to place the long position. What is happening? Okay. Price. Oh, price. My fault. I'm going to place a market order. That's better. Market order means is the price is currently like changing rapidly, right? So whenever I click the open long position, that it is going to fetch that price, the like that dynamic price. Order placed successfully. As you can see, it was as simple as that. I didn't need to do anything, and I'm going to sell it now. Oh no, not now. Okay, I need to explain it to you first. So this is the contract which I was talking about. So the symbol, okay, BTC. I bought BTC. Size 0.006 BTC. Entry price, okay. So this is the first thing that I told you, that I taught you, right? Entry price. Where did it go? Current price of the stock or coin. So this is the entry price which I was talking about. Forget about mark price. This is something complicated. Liquidity price. Forget about this one as well for now. Margin ratio, margin PNL. So PNL is profit and loss. As you can see, I'm suffering a great loss of minus $0.08. So this is red. That means I'm suffering a loss. So why am I suffering a loss? Just see one thing. Okay, I'm not now I'm having some profit of $0.00. 39,391 is my entry price. What is the price now? 39,091. Okay, remember 91 is my entry price. 91. 391 is my entry price. So $400. So I must be, this is now 398. I entered at 91 and I opened a long position. So I predicted that the price is going to go up. So I must be having some sort of profit. See, I'm having a little bit of profit, $0.05. And now let's wait until it goes down below 91. So I can show you that if if I predict it wrong, then I'm going to see it's 78 now. I should suffer a loss. See, red. Are you getting this, everyone?
Yes.
Okay.
Yes, sir.
Okay, nice, very good. So this is what a futures price prediction actually is. So all you now need to know is how to predict the price. That is the entire game of stock market, and that is the entire game of. But first, I'll let me sell it. Oh, oh, thank God I didn't sell it. Okay, I'll sell it later. So now the entire game is to predict what is going to happen. So you can, as you can see, I'll just show you where I suffered a $50,000, 50,000 rupees loss. This is where I suffered a 50,000 rupees loss. Okay, so you can see that the price never went down as much. It went down this at like this time around, like 21st May 2001. I even saw a amount of $8 billion being liquidated in an instant when the price went down from 44 like $44,000. Like, people suffer losses over
Yes,
here.
sir.
Which, who are the people who suffer loss? Like, they are the people who plays the long bets. These are the people who suffer losses at this point. This is known as liquidity avalanche. I'll just type it. This is known as liquidity or avalanche.
So then what is preferred, wrong or short?
It depends. What do you prefer? Whether you are a batsman or a bowler? It's that type of
Achha,
question.
okay, sir. Okay.
Okay. So, whatever you think that is best for you. Where you want to be a bear, you must know when a market falls. And oh, okay, fine. I profited $0.3 thanks to you guys.
Welcome.
Okay. Now, yes, coming back to the question. If you are a bear, you must understand when a market falls. So if you know all the reasons and statistics and mathematics as to why a market will fall at this point of time, then you are a great bear. But again, on the other hand, if you understand why a market will rise at this particular point, then you are a great bull. That is what makes you a great trader. A trader is never like a professional trader is never a bull and a bear at the same time. It is because all rounders are really very difficult to find. Professional all rounders are
Like
really very
Ravindra
difficult to
Jadeja.
find in stock market. Yes,
Yes, sir, like Ravindra Jadeja all-rounder.
yes, exactly. So a professional all rounder like a batsman and a bowler is very very difficult to find. It is because it is itself really very difficult to predict the stock market, especially the crypto market. It is because it is so very volatile, right? Stock markets can be predicted, but the crypto market is so very volatile that the prediction of a crypto market is next to impossible unless you are really very well versed with what a crypto market and how the price of crypto market goes up and down. It took me nearly 2 years to understand this. So you can guess that how difficult it should be. Like, I'll give you a really short example. Like, if you people are well versed with stock market, or even if you're not well versed with stock market, so say for example the price of Google is $100 million. What did I say? I said that the price of Google shall go up or shall go down depending upon what is happening inside the company. So if the company is suffering from a huge loss, like a huge loss, it might suffer like a loss of $100,000 or $200,000 at a time. But that it itself will take time. Like, a company is not going to go down in an instant. Like, a company like Google is not going to go down in an instant. It's not going to lose 50% of its belongings in an instant, right? Like, for example, today the price of Google is $100 million. It is obvious that the price of Google is not going to be $50 million tomorrow. Is it possible? Not possible. But just just look at Bitcoin. Just look at Bitcoin. You'll be surprised if you see the date over here. Can you see the date? 13th April
Yes, sir.
2021.
Yes.
And just see the date over here, 19th May 2021. What is the price in 13th May? $65,000. 14th April, I'm sorry. 14th April, what is the price? $65,000. What is the price just 1 month later? 1 month, 5 days, $28,000. It lost not just half of its, but more than half of its value. This is what the volatility of a crypto market is. In just a month, you can lose everything that you have gained. And but don't take this in a negative way only. The positive thing is that you can make more money out of it in a short period of time. Like, there is a dialogue in Scam 1992. Risk hai to isk hai. Like, do people must remember this dialogue? Risk
Yeah,
hai
we remember that.
Yes,
to isk hai.
yes.
This is really important. Important to understand the stock market. The more you take risk, the more profit you make in less period of time, in lesser period, like in shorter time span. But in case of stock markets, you need to wait a year, or a quarter of a year, or like half a year, and after that you will make some profit. But in case of crypto market, no, day trading is it. Forget about day trading. Let me show you something known as a swing trading. In case of swing trading, you need to follow 3-minute graphs, and you place your bets and complete your bets within 3 minutes. In 3 minutes, you can make profits more than what you might have made in 6 months from stock market. It is as volatile and it is as profitable as it looks like, but it is risky as well. So the like, I would say 95% of the people might suffer loss from stock market. If 95% of the people suffer loss from stock market, 99% people suffer loss from crypto market, and the rest 1% are billionaires. And that is the reason why futures like the futures platform of crypto market is dangerous, but it can make you a billionaire. It is the best spot for the people who know how a crypto market works. So as a beginner, you people must be beginners. I will never suggest you to use futures. You must be first very well versed with how a spot market works, because in a spot market you shall never suffer a loss. It is because as long as you don't sell what you have bought, you're not going to suffer a loss. You can keep your bitcoins, like for example, I am buying a Bitcoin at $39,000. The price goes as down as to what $2,000, but I will not sell it. If I don't sell my BTC, I am not going to suffer a loss. As soon as I sell my BTC, I'm going to suffer a loss. But if I keep it for eternity, like as long as I want, I'm not going to suffer the loss. Right now it is $39,000. 1 month later, it might be $8,000. I didn't sell it, but after 2 months, the price went up to $60,000. Then I sell it. I it's like I had some profit. I had profit of $30,000. Okay. But in case of futures, there is something known as the liquidity price. I was showing you showing you the position, like there is something known as a liquidity price. So for example, this is the last thing that I will be teaching you. So coming back to the opening of contract, there is a liquidity price over here. This is the main player of the game. This is a player which this is a guy which you should be afraid of. Array auto liquidity price. So what is the liquidity price? This is where the game changes entirely in case of a futures market. So the current price is $39,000. You're placing the long bet. So if the price goes down to $38,000, you're suffering a loss of $1,000. It is as simple as that. But say the price went even down further, like $37,000, you're going to suffer a loss of $2,000. But say the price went even further, like $35,000, you are going to suffer a loss of how much? $4,000.
4,000.
But I invested only there, like there is a price, there is a thing known as invested money. I invested just like $3,000, but I'm suffering a loss of $4,000. How is that possible? So the liquidity price should be how much? $36,000. So do you understand that if the price reaches $36,000, I'm going to lose the entirety of my money, even if I don't sell or perform any kind of operations. I'm going to lose my money entirely. And this is where liquidity price comes in. It kicks in really very hard. If you invest 3,000,
Can you explain again, please?
okay, fine. So suppose you are investing just $3,000, okay, 3K, 3,000
Yes.
rupees, $3,000. The current price is $39,000, okay, and you are playing long. Long means you are predicting that the price is going to go up. So if the price is $40,000, you are going to have a profit of $1,000, right? It's as simple as that.
Yes.
Now, if the price goes down to $39,000, sorry, not 39, $38,000, then you're going to suffer a loss of $1,000, right?
Yes.
Now, say the price went down to $35,000. So, how much you're going to suffer a loss? $4,000, right?
Yes.
But you invested just $3,000. You're suffering a loss of $4,000. It is as like it is equivalent to like I'm whatever money I invest. Like I am placing a bet of 100 rupees, but then again people catch you by the collar and say, "Oh, you invested 100 rupees, but I won 100 more." It is equivalent to that. It should be like limited to the money I invest, right? The loss or the profit should be limited to the money the loss, not the profit. The loss should be limited to the money I invest. So if I am investing $3,000, that is the maximum amount of money I should lose. It should not tap into my bank account and take in another $1,000 from me, right?
Yes, yes.
So the closing price maximum, it minimum, it can go to $36,000. That is the liquidity price. You understand? This is not exactly how the liquidity price is calculated, but it is analogous so that you can understand.
Yeah, understood.
You understood? Okay.
Yes.
So it is similar in case of short position. So for example, the current price is $39,000. The closing price is $40,000. Loss, I'm suffering a loss of $1,000. So now investing price, invested amount, say $3,000. Okay. So the how much should the liquidity price be? Forget about the closing price. How much the liquidity price should be? 39 plus 3. It's as simple as that. $42,000. So if the closing price is $42,000, I'm going to suffer a loss because I'm playing short. I'm by playing short, I mean if the price goes up like more than $39,000, then I'm going to suffer a loss. If the price goes down, I'm going to have some profit. But if the price goes up more than $39,000, I'm going to suffer a loss. So if the closing price is $40,000, I'm going to suffer a loss of 1k. If the price is going to go to $41,000, I'm going to suffer a loss of 2k. If the price is going to go to $42,000, I'm going to suffer a loss of 3k, and I will stop there. It is because the invested amount is 3k only. You understand?
Means I have to manually stop that, or is
No,
there
no, no,
any
no.
option?
You don't have any control over that, and that is who wants the manual. Everyone wants manual control. Like if I'm seeing my price, my $3,000 is going to get liquidated, like I'm going to lose all my money. I should be able, if I am able to manually stop that. Like everybody will stop that, right? You want to stop your money from
Yeah.
getting liquidated, so it's not manual; it's automatic. So once the contract is placed, it's placed unless you stop it in between before the price is liquidated. I'll
Acha, means before the price get liquidated, I have the option.
You saw I just sold my position at $0.05
Yeah,
profit.
yeah.
Okay, I was suffering a loss as well at one point of time, like minus $0.05, but I still had the option of selling. Okay,
Mm,
so
mm.
unless I am absolutely uh, void of the money that I have invested, I won't. I will be having a option of selling my position. Okay, so I'll just show it to you in practical terms. Like so, for example, I'm investing 20% open long market position, open long. Why this doesn't work fine? I don't know. What is the problem? Order placed successfully. So I'll just wait for yes. See, I'm suffering a loss of $0.06. Okay. Wait. I'm suffering a loss of $0.03, but I can click on the market and the order placed successfully. I suffered a loss, but I was able to sell my position. If I go into the income history, you can see I suffered a loss over here. Realized P&L, I'm sorry, over here. I suffered a loss, but I was able to sell my position. So unless and until my entirety of the position is liquidated on its own, or before I am able to stop it, okay, the thing is automatic. You understand? Like it is
Yes.
completely automatic unless and until you sleep overnight, like you placed a bet of short or long, and you slept, the price went down to $36,000. In the morning you see you have lost, you have suffered a loss of $3,000. That is how mostly people suffer losses in trading. Like you can't be in the on your computer 24 hours, right? You sleep, you die. It's really as simple as that. It's nothing more. Like futures is nothing more. It's as simple as betting. Okay, do people have any questions? Like I'll be entertaining questions now.
No, I don't have.
Suman Karmakar, do you have any questions? Ayman Asha, Siddhi Agarkar.
No single question as of now.
Okay, someone message. People. Okay, so if you people don't have any questions, we shall conclude our session right now. Okay, is there any problem with that?
Acha, acha.
Yes.
Sir,
If suppose if I have 100 rupees,
Okay.
with 100 rupees only can I trade in crypto, or is there any minimum barrier limit?
Oh, okay. There is a minimum barrier limit in with every crypto platform there is, but it depends from platform to platform. In our platform, the barrier is $10. Okay,
Oh,
800
okay,
rupees.
okay.
sir, I have a question. It's related to stock market but not crypto. Can I
Yeah, yeah,
ask?
sure, sure, yeah, sure, sure.
So, like in stock market, we buy shares, but while we are investing in mutual funds, what are we buying?
Okay, mutual funds. It's uh, it's equivalent to shares. Okay, it's absolutely equivalent to shares. What do you mean by mutual? Mutual means both ways, right?
Yes.
Mutual means both ways. So if I make profit, you make profit. If I loss, oh, the English is going to be really bad. If I lose, you lose. It's as simple as that. That is the reason why, if after every mutual fund advertisement, you'll see these advertisements are subject to market risk. Please invest in your risk.
Yes,
Okay,
yes.
you will see that. It is because people will tell you profit, profit, bhai, bahut profit, but they won't tell you that you are subjected to lose. You are subjected to losing your money as well. It's not just profit. No mutual fund will tell you that I am going to guarantee you profit, because you are subjected to losing your money as well. Okay, so that is the reason why there are some trusted mutual funds, but trust doesn't mean that it can't be broken. Trust means that the record is really very good, that the record of pleasing their customers with profits, it's really very good. Okay, the more uh, the more profit you make, the more risk is involved. Risk है तो इसके, this dialogue will help you in a stock market career like no other dialogue. So the more profit you make, the more risk is involved. So in some mutual funds you will be making like thousands of rupees, 50,000 rupees, 60,000 rupees, but one point of time you will see that your entire money, you have lost your entire savings. Like there are mutual funds like that, but I won't say those are mutual funds. Those like, there are things like hedge funds. Okay, what do hedge funds do? They tell you they'll be giving you 23% per year annually of your entire savings, of your investment. Mutual funds They rarely say they are going to give 7%. You're seeing the difference, 7% and 23%. It's huge. It's 3 times. But the risk involved is here is 3 times more. Oh, sorry, 3 times more. And the risk involved here is is like really less. And answering your question, it is almost the same, not entirely, but almost the same. It is because the companies of mutual funds, they do not depend upon stock markets or any other hedge funds to increase their um like asset value. They use their own methods. That is the only difference. Like, it is almost similar to buying stocks. Okay, are there any other questions?
No.
No, sir.
Okay, so I guess we'll conclude our session today. I hope you guys enjoyed it. It is really very interesting topic. Like every other person you see, I see people from mechanical. Last time I conducted this seminar NIT from NIT, there were like 60 to 70 students, but most of them were from computer science background. But this time I'm seeing that the people are from mechanical science, mechanical background, electrical, and all that. All sorts of people are getting interested in crypto, stock markets. It is mainly because of the recent trend. But
Yeah, the trend, because of trend, I came here.
yeah,
Yes.
because of the recent trend, it's good. It's good.
Yeah,
You
I should know but if someone is talking that I should know that what that if other person is talking about crypto. Yeah.
now you understand a little bit more the about
Yes.
crypto, I
Yes.
guess. If you are not able to understand, you can always contact me. I'll drop my contact over here. You can always contact me. You can always email me regarding your problems. I'll try to solve it. And